Relief from inheritance tax can be available on assets that qualify for agricultural property relief or APR. Qualifying assets include land and buildings used for the purposes of agriculture and can include assets that you use in your own farming trade or that are used and occupied by somebody else. APR is only available on the agricultural value of assets, which could leave some value exposed to IHT. Where you're using the assets in your own trade, you may be able to benefit from BPR or business property relief, which would give an exemption on the full market value of the assets. Before the 5th of April 2026, APR was unlimited, meaning a full exemption from tax was available on qualifying assets. The rules changed from the 6th of April 2026, and now only the first £2.5 million of qualifying asset per individual are exempt from inheritance tax. Anything over that threshold is taxable at an effective rate of 20%. The £2.5 million threshold is per individual, and any unused amount can be transferred between spouses on death. The threshold is a combined value for both agricultural and business property relief. These rules mean that any individuals who have qualifying agricultural or business interests with a value of more than £2.5 million have a potential inheritance tax exposure on those assets. So what do these rules mean in practice? If you own farmland that is worth £2 million, assuming you have no other qualifying assets, the full value would be covered by the £2.5 million threshold, and so no inheritance tax will be payable on these assets on your death. But if the farmland increases in value during your lifetime, this may not be the case on your death. Also, if you plan to sell the farm before your death, the assets that qualify for relief today would not qualify once there is a binding contract for sale. So even if you have no inheritance tax liability today, that does not mean that you should not think about the future and potential tax planning opportunities. If you have a farm worth £4 million, you could have an inheritance tax liability of £300,000, which is 20% of the value over £2.5 million. If you could have an inheritance tax liability on your agricultural assets, a key consideration will be how this could be funded after your death. If you own qualifying agricultural assets, what should you be thinking about now? First, understand whether you do have a potential liability. As I mentioned earlier, even if you don't have a potential liability today, that does not mean you should not consider planning opportunities now to prevent a future liability. Once you understand your current position, you can consider what steps you might want to take to mitigate the potential liability. Depending on your circumstances, this could involve transferring assets to your spouse, giving assets away to future generations, or transferring assets into a trust. You should also review your will to ensure that the £2.5 million allowance can be used effectively and allows for post-death planning.